You did everything you were supposed to do. You followed the rules, diligently saved in your 401k, and trusted that it was the smartest move for your future. You have watched that balance grow, feeling secure. But what if that security is built on a myth? What if you have unknowingly been walking into a financial trap, one that's set to hand a huge chunk of your nest egg directly to the IRS, and that too right when you need it the most? This isn't a mistake you have made. It's a flaw in the system that you were told to trust. In this video, I'm going to show you exactly why your 401k could be a ticking tax bomb and what you need to do starting today to defuse it. We have all been sold the same story on the traditional 401k. The pitch is simple and, let's be honest, pretty seductive. Contribute money from your paycheck now and you get an immediate tax break. Your taxable income goes down, you pay less to the government this year, and that money gets to grow tax deferred. It sounds like a fantastic deal. And for decades, it has been the cornerstone of American retirement planning. But here's the fine print nobody ever puts in bold. Tax deferred doesn't mean tax free. It just means you have a silent partner in your retirement account. That partner is the IRS, and they have been patiently waiting while your account grows for decades. Every dollar you put in, every dollar of your employer's match, and every single dollar of growth, it all belongs to that partnership. And when you retire, your partner is coming to collect. The trap isn't that you have to pay taxes. The trap is that you have far less control than you think over how much you will have to pay. You have entered into a deal where the other party gets to decide or gets to set the final terms, and that too decades down the road. You are betting your retirement on a single dangerous assumption that you will be in a lower tax bracket in retirement. For many successful savers, that assumption isn't just wrong, it's a catastrophic miscalculation. Think about it. Are your expenses really going to plummet in retirement? Sure, you might pay off your house, but property taxes, they are forever. Your kids might be grown, but you will want to help your grandkids. You will want to travel, you will want to enjoy hobbies. And most importantly, you will have to pay for healthcare, which only gets more expensive. For many people, the income they need to live comfortably in retirement isn't honestly that much lower than what they needed while they were working. And the problem is, you have fewer deductions. The mortgage interest deduction is likely gone. Child tax credits are most likely a distant memory. And what's the result? The same amount of income can easily land you in a higher effective tax bracket than when you are actually working. This is the fundamental flaw. The 401k system was built on a premise that is proving to be a myth for millions of savers. And that myth is about to collide with two brutal realities: the future of tax rates and the government's unforgiving withdrawal rules. The trap truly springs shut because of two powerful forces that will converge when you are in your 70s. The first is the simple uncertainty of future tax rates. Does anyone really believe that tax rates will be lower in 10, 20, or 30 years? With national debt where it is, that's a risky bet. By deferring your taxes, you have essentially given the government a blank check to decide the rate when you are in your 70s and 80s, and you have the least flexibility to do anything about it. And the second force is even more powerful because it strips you of control. This is called the required minimum distribution, or RMD. Once you turn 73, the IRS stops waiting. They knock on your door and say, hey, it's time to pay up. They force you to start withdrawing a certain percentage of your tax deferred accounts every single year, whether you need the money or not. That age is currently 73 and it's scheduled to go up to 75 in 2033, but the principle will remain the same. The government wants its tax revenue, and the RMD is how they guarantee that they get it. Let's make this a little real. Imagine you did everything right and you have saved over $1 million in your 401k. You feel like a millionaire, but honestly, you're not. A big piece of that $1 million is an IOU to the IRS. In your first year, the IRS could force you to withdraw over $36,000, which is taxed as ordinary income. And this gets added right on top of any other income that you have, like a pension or social security. And this is where the tax torpedo hits. That forced RMD income can suddenly cause a larger portion of your social security benefits to become taxable. So, a withdrawal you were forced to take not only creates its own tax bill, but also increases the taxes that you owe on social security. It's like a double whammy. And it gets worse. That higher income, artificially inflated by the RMD, can also cause your Medicare Part B and Part D premiums to skyrocket. This is called the Income Related Monthly Adjustment Amount, or IRMA. You can be pushed into higher IRMA tiers, costing you thousands more per year in healthcare premiums just because the government forced a withdrawal from your own savings. Let's recap this nightmare. You are forced to withdraw money you may not need, which pushes you into a higher tax bracket, which makes more of your social security taxable, and which jacks up your healthcare costs all at the same time. You have lost control. This is the 401k tax trap in action. If this is starting to sound alarmingly familiar and you are worried your retirement plan is a ticking time bomb, don't panic. Recognizing the problem is the first step. And to help you solve it, I have created a free guide called the 3 step tax diversification plan that walks you through these strategies that we are covering. You can download it right now using the link in the description. Now, let's talk about how to escape. So, how do you get out of this partnership with the IRS? Obviously, you cannot avoid paying taxes completely, but you can choose when and how you pay them. The single most powerful strategy to diffuse this time bomb is to convert your tax deferred accounts to tax free accounts. It's actually a very simple idea. You take a portion of your traditional pre tax 401k or IRA and you move it into a Roth IRA, or even better, an IUL. I like to call an IUL a rich man's Roth because it has no restrictions on the contributions or income limits. When you do this, you pay ordinary income tax on the amount that you convert right now. I know it sounds really painful. I mean, why would you volunteer to pay taxes sooner? Because you are strategically choosing to pay taxes today on your terms at tax rates that you know to avoid paying unknown and likely higher tax rates later. Think of it as buying out your silent partner. You are settling that IOU with the IRS now so that all future growth in that money is 100% tax free forever. Withdrawals from an IUL and qualified withdrawals from a Roth IRA in retirement are completely tax free. And this is a game changer. The cash value in an IUL is also not subject to RMDs. No forced withdrawals. That money can keep growing tax free for as long as you live. A big withdrawal for a new car or a medical emergency won't create a massive tax bill or trigger those Medicare surcharges. It gives you back the control that RMDs take away. But the key is to be strategic. You don't want to convert your entire 401k all at once because that would create a monster tax bill. Instead, you do partial conversions over several years. A great time to do this is in the gap years, the years between when you retire and when you start taking Social Security or RMDs. In these years, your income is often at its lowest point, allowing you to convert funds while staying in lower tax brackets. You are methodically moving money from a taxable future to a tax free future 1 year at a time. The second core strategy, which goes hand in hand with IRA conversions, is to stop thinking about a single retirement account and start thinking in tax buckets. The biggest mistake people make is putting all their eggs in one basket, the tax deferred bucket. But to build a truly resilient retirement, you need actually 3 buckets. The first bucket is your tax deferred bucket. This is your traditional 401k and IRA. You got a tax break on the way in, but you pay taxes on the way out. This is the bucket that is subject to RMDs and future tax rate risk. The second bucket, and most important for our escape plan, is the tax free bucket. This is your IULs and your Roth IRA. You pay taxes now, but all qualified withdrawals in retirement are completely tax free. This is actually your escape hatch. This is where you want a significant portion of your assets. And the third bucket is the taxable bucket. This is just a standard brokerage account. You pay taxes on dividends and interest as you go. And when you sell investments, you pay capital gains tax. While this isn't as tax advantaged as an IUL, this bucket offers incredible flexibility. Long term capital gains are often taxed at much lower rates than ordinary income, and you can access this money at any time without any penalties. Having money in all the three buckets is the ultimate power move to escape the tax trap. Why? Because in retirement, it gives you total control over your taxable income each year. In a year where you need a little more income, you can pull from your Roth IRA tax free to avoid jumping into a higher tax bracket. In case of healthcare emergencies, you pull the living benefits again tax free from your IOL, and sometimes you pull from your taxable accounts. You can blend withdrawals from the different buckets to perfectly engineer your tax bill, keeping it as low as legally possible year after year. This is how you navigate around the Social Security tax torpedo and the Medicare or March surcharges. You have options. You have control. You are no longer at the mercy of the IRS's rules. Honestly, your 401k is not a bad tool. It helped you build your nest egg, and the employer match is free money. You cannot beat it. But relying on it exclusively without a clear strategy to manage the income tax bill, that's a trap. It's a trap built on the outdated myth of a low tax retirement and enforced by the iron fist of required minimum distributions. But honestly, you do not have to fall for it. By understanding that tax deferred really just means tax postponed, you can change the game. You can start taking control today. You can use strategic conversions to methodically move your savings from a taxable future to a completely tax free one. You can diversify your savings across tax deferred, tax free, and taxable buckets to give yourself ultimate flexibility and control. You have worked far too hard for far too long to unknowingly hand over a huge chunk of your life savings to the government. It's your money. By building a deliberate, tax aware plan, you can make sure that your retirement savings stay your retirement savings. If this video opened your eyes to the hidden dangers in your retirement plan, please hit that like button so more people can find this information. And subscribe for more no nonsense financial strategies that put you in control. And don't forget to grab that free guide, the 3-step tax diversification plan. The link is in the description below.